Mortgage rates dipped to 6.125% last week. Then they snapped back to 6.35%. Now, this is still a one-year low and fantastic for buyers today. But it does prove one thing, that mortgage rates do not move in straight lines. So if, as a buyer, you're sitting waiting for that perfect moment, you're going to end up waiting for forever. Today, I want to break down exactly what shifted right after the Fed decision. Why October 12th through the 18th is being called the best week to buy, and why this fall may be the opportunity of a lifetime if you know how to play it. So I mentioned the mortgage rates, they're sitting at 6.35% today compared to 6.125% on Fed Day. So why the jump? I mean, the Fed cut the Fed rate by a quarter, but ultimately the Fed was not dovish enough, and Powell's tone hedged. Investors did not like that at all. Then the very next morning, initial jobless claims and continued jobless claims fell back to where they were 3 weeks before. And that means the labor market is still resilient. And then retail sales grew 0.7% month over month. That's more than double the pace of the preceding month. Americans are still spending in the face of sticky inflation as equities and cryptocurrencies continue to stay at record highs. The Fed also revised their GDP estimates higher. A stronger economy has less urgency for Fed rate cuts. And the dot plot, now we get that 4 times a year, and it gives us a heads up as to where the Fed governors think the Fed rate is going. And it shows 2 more cuts this year, but only 1 in 2026. Meanwhile, the newest member of the Fed, Stephen Moran, he dissented in a big way. He wants 5 cuts squeezed into the last 2 meetings of the year. Well, that's not going to happen. This dissension shines a spotlight on the growing division inside the Fed. It raises questions about their independence. Markets don't just react to Fed cuts. They react to confidence in the Fed's roadmap. Investors ultimately price the future, not today. And Powell's tone mattered more than the cut itself. Right now, the blurred Fed independence, like Moran keeping his White House job while voting at the Fed, has investors demanding higher yields in order to hedge their risk. Higher yields mean mortgage rates stay sticky even with those Fed rate cuts. Something else that could have helped rates would have been a little head nod towards the Fed purchasing mortgage-backed securities. More demand on this longer-term bond could have helped rates drop further. Instead, Fed Chair Powell commented that the Fed was going to continue their quantitative tightening or their bond roll-off, putting more supply into the markets, dropping prices, and keeping our rates elevated. Now, here's where this ties back to buyers. Realtor.com just reported that October 12th through the 18th will be the best week to buy a home in 2025. Based on their data, we have 32.6% more homes for sale compared to January of this year, and prices are about $15,000 lower than they were in their peak season. Plus, they're also seeing up to 30% less buyer competition. Right here in Denver, the same week was flagged. Active listings are up 22% year over year, and 58% of homes cut their asking price last month. An MBA just reported applications surged off their bottom nearly 30% last week as buyers are jumping back in whenever those rates dip a little. So why is now an opportune time for buyers? I want to share a real life example from a conversation I just had with clients who are living in their parents' basement, hedging their bets that next year is going to be better. They want to save longer for a bigger down payment. But when we ran the numbers, especially given this opportune time, we realized that what they might make in a slightly lower payment a year from now is offset by the strong seller concessions to buy their rate down permanently in today's market. Now that's clarity. So let's talk about the builders because they're having an impact on the market in a big way. Sellers are already having to cover closing costs and rate buy downs, but builders, they're setting records. Lennar, who's ranked 129 out of the Fortune 500 companies, just offered their highest incentives since 2009, 14.3% of their sales price. Now, I want to put that in perspective. That on a $600,000 home, that's $85,000 $5,800 in incentives. I mean, that's massive. And that's why they can offer such low interest rates in this market. Lennar is buying their way to market share by buying their way to the bottom. And it forces resale sellers to compete by offering even more in concessions. Let's be real. For the fourth quarter or even next year, lower rates are not guaranteed. Inflation right now is still sticky. Headline CPI coming in at 2.9% and core at 3.1%. Job growth is weak, only 22,000 in August, and revisions erased months of data. Yet it still stays stable. I mean, volatility right now is the rule, which is why timing the market perfectly is a trap. You win by acting when the window is open and the time for you is right. My takeaway in all of this is rates are bouncing. Builders are handing out the biggest incentives in 15 years, and buyers have more leverage than they've had in a decade. Denver's sweet spot is October 12th through the 18th. And nationally, this fall could be the best buyer window since pre-pandemic. So if you're waiting for certainty, you're going to miss it. I want to run your numbers today. I want to see how can you capitalize while sellers are still literally handing out tens of thousands of dollars in incentives. Because hesitation costs money, yet clarity builds wealth. I'm Nicole Ruth. I'll see you next week.